Uh, Jeff, Zach, thanks for joining me.
Hey,
Hey
Steve.
Steve, thanks for having us again.
Hey, we're talking again about residential home prices, talking about the potential for a crash. We're actually on the S&P Case Shiller Home Price Index. We are back to levels of 2008. That's got some people concerned, but there's a bunch of reasons, and we can go into some of those, why most experts, most economists are not seeing a crash around the corner. Just kind of, your guys' thoughts, and I think we'll get into some of those reasons, and we have before, on why we don't see a crash, but home prices are certainly elevated at these levels.
Yeah, no, I agree. I think pricing is certainly still ramping up too. Interest rate cuts, I think, are going to unlock some supply, which might help with the growth. Slowing it down, but it hasn't shown any signs of slowing down yet. Um, a lot of reasons why you're not going to see a crash. There's a lot more equity in people's houses these days. You're not the underwriting risk has been taken away. You're not just giving a loan to anybody. So between those two things, you've got a lot of strong borrowers that are able to afford their houses as opposed to reaching for stuff like they did in '08 and '09, which were done with basically like phantom loans. So I don't see personally a crash. I think we're on strong footing.
I would probably clarify that a little bit. That doesn't mean that you're not going to see regional type crashes, right? Like where places, have job loss associated with, employers moving out of different areas and, but the reality is I think overall across the market, there's lack of supply, and greater demand. The other side too is I think, maybe there should be a small discussion of the value of the dollar with inflation. So costs are higher than it's not exactly the same as what 2008 was, even though 2008, prices, that's kind of what we're looking at right now. So, I think it's just a different market, a different discussion. And by the way,
I,
and to point
actually,
Zach's point, the other side is, you know, after again, I mentioned this last time, Dodd-Frank changed the dynamics of lending. It's not what it was, and changed the dynamics of banking. Banks are, you have to have the equity, you have to have the general metrics to even get a loan. Doesn't mean there's not going to be problems. There will, but it's not like it was before.
Well, debt to income is a
Yeah.
big piece of that too. I mean, you could have debt to income in '08, '09, 50, 80, even 100%. And this time, mortgages won't be issued if you're above, I think the cap is about 40%. Some banks might go as high as 50, but you're typically looking at private money as opposed to like a Fannie or Freddie, which is where all the mortgages come from. So when you're talking about going to a bank and getting a traditional mortgage, you have to have debt to income or you're not going to get a loan. And so, some people's personal situations may change. You might have layoffs and otherwise that can impact in a short term, but people don't typically stay unemployed. And with a stronger balance sheet and more equity in these homes, you're not seeing a fire sale of stuff that's underwater or upside down even, where they owe more than what the house is worth. So
Right.
you might see some stuff sell off, but I don't see a tremendous crash.
yeah, and I think we all get a chuckle out of what they call the ninja loans, no income, no job, no problem. But those were real things back in '08. And as you guys point out, the credit standards are a lot higher. I think, Jeff, you made a great point that not a lot of people also often point out too. It's more expensive to build houses now, and that goes into why builders not creating enough supply to meet demand could be a bit more extended than it otherwise might be. We've certainly got demographic trends. That are supportive of more demand. As we mentioned, that not much in foreclosure activity. We've hit like lending standards are much stricter now. Obviously, inventories lower than it was. I mean, those are kind of the big reasons given. I think you'd need a serious type of kind of black swan economic type hit that is just unlikely. It's not like, if we sit down and we try to work really hard, we can maybe come up with something. But it just, it's not likely that we're going to have something to create so much job loss, so much distress. You're really looking at a big outlier event. Um, but I would say that when you look at where prices are, the Case Shiller Index is a great example. because adjusted for inflation, that is showing you're back to around '08 levels. And if you're not going to get a crash, which it seems unlikely, and prices are this elevated, what it probably points out to is if you're going to invest in real estate, you probably should look somewhere else than residential single family homes because you're probably not going to get super good returns on them with where the prices are. You could see these markets going sideways or down for a while. And that's another way to address prices being too high is to just not get price gains for a while.
Yeah, I
Right.
mean, the other side you might want to consider as well is if builders when they buy land to develop homes don't buy them, in 20 days and then 40 days later they're building a home. They've got inventory that they have for years and years and years, waiting for the right time to do it. Now, if you add that to the nuance that prices are steadily on the rise because of lack of supply, what keeps some of these builders from, holding back some of their inventory so that they're selling prices for higher while their costs are still a little bit lower than what they probably could be or should be. And to be fair, I've spoken to a couple builders that they do that. They play the game just like everybody else.
Well, one thing to point out in terms of credit, because I've got two things that I would say, but in terms of credit, you don't have the adjustable rate mortgages that are going to reset 5 or 8% higher. So you're missing that piece as
Or
well.
negative AM.
Right. So
Yeah.
you have a lot less risk in that's been taken off. But in terms of builders, you might see pockets, to what both of you are saying, of some price reduction, price sideways. I have seen some markets where people are selling lots and then building houses, and those houses are sitting for 100 or 200 days. The reason they're sitting isn't it's not that it's a bad house or a bad area. It's that they wanted to come out and charge $875,000 for a 2,400 square foot house that's only worth about 500. So they've cut the prices down to 500, and builders are kind of getting caught on some of that stuff. And then the houses will trade,
Mhm.
550. So you are seeing some normalization of prices, but I wouldn't call that a crash. I would call that, selling for what it's actually worth instead of, people are not able to be as greedy now as they were during the pandemic. So that's normalization. I don't see a crash because the values are holding where they should be holding.
Yeah, and to also go back to Jeff's point, it doesn't mean you couldn't get a crash in some individual markets. I mean, if we hit the next recession, there will be at some point a next recession. You could see some areas that don't have positive demographics, some areas that businesses aren't going into, some areas that aren't the areas that people are moving into and want to. You could see some areas have crashes, absolutely.
Like San
And
Francisco.
well, yeah, I mean, downtown SF is, yeah, we've covered it before. We'll probably cover it again. That has been an absolute nightmare for owners and investors. Although residential in the areas that look down upon the downtown and all the homeless and stuff have been doing just fine. So that even in like one area,
Well, I mean, look, the
you
other
can
side
have
is,
different markets. Yeah.
Zach and I looked at a project yesterday. I mean, very, very briefly, pricing seemed okay, but when you start digging into the demographics of the deal, it was a hard no very quickly. The average household income was well below the national average, and I mean well below the national average. Yet you're trying to increase rents up to what the national average. It just, doesn't make sense. So, yeah, I mean, that's kind of the point is with what we do and how we invest, we're looking for projects that make sense, not in markets that are, let's just say dwindling to some degree, like downtown San Francisco.
Yeah, and I would make two other points is, one, if you're in a market that has a major reduction in prices, you don't care if nationally it's
Yeah,
happening or not.
right.
What you care. So, I would say to investors, don't worry so much about a national crash. It's a real anomaly. It's happened like, twice in the last 200 years. Worry more about what you own and what you're
Yeah.
buying. And I think, we all agree that when we look out at real estate, this is not the sector we look at and we see, wow, we want to be buying here. It doesn't mean that we don't like residential in terms of multifamily, but not all multifamily. We're pretty selective in where we look.
Yeah.
But yeah, a lot of single family residential. where the pricing is doesn't really excite us as investors.
Well,
Zach, you were going to add that, I thought, or maybe he stole your thunder,
no, no. I think we
picked
kind of
the
covered.
horse.
Yeah.
Okay, well, thanks for the insights. Hey, I'm sure some folks out there want to tell us where we're wrong about this, so feel free to fire away at comments. Let us know what we're missing here. If you enjoyed the video, give us a thumbs up. Visit our website, selectfincap.com, and get on our newsletter list. Get on that list so you can see exclusive commercial real estate investment opportunities, which are probably not going to be single-family residential homes, but lots of places where we like the pricing. Thanks a lot, guys.
Thanks.
Thanks, guys.